Welcome to the TEK2day podcast powered by CEO Rater. It's your host, John Mayetta. Visit us at CEO Rater. Rate your company, rate your CEO. It's always anonymous. Check us out at TEK2day.com. We've published a lot of content in the past several weeks of the markets have been volatile. You know, our view, we're bearish on the economy. We had an interview podcast with SS&C Technologies, and we embedded that in an article we put out last night called Verticalization is Where It's At. If you know this podcast, you know I'm a fan of vertical business models. And so you can read all about that at TEK2day. And we had a couple of other articles that we published overnight. Tesla, we applaud Elon Musk. We're not often in agreement with Elon Musk, but insofar as opening Tesla's Fremont, California plant, we're big fans of that. Because if you wait for the state of California to open, Governor Newsom's just happy to see that deficit grow. It's almost as if he were willingly plummeting the state into a intentional bankruptcy. We can't have an economy and a society that comes to expect bailouts, which is where we're at now. That creates enormous moral hazard, and it kills our inherent economic growth engine. Because you're incenting people and companies to not work, to take undue risk. It's just counter to everything about capitalism. And for those of you who haven't studied socialism, it doesn't work. It hasn't worked. It can't work. The last article we put out, the pain is coming and the recovery will be uneven. And so in this article, we're speaking not only about the broad economy, but also about enterprise software valuations, which are overinflated. You've got a number of companies that are trading 30, 50 times revenue or better, EV to revenue. That's outrageous unto itself. And some investors will tell you, well, you know, we've had low interest rates since the 08 downturn. You can't really find yield in fixed income. Therefore, you've had capital has funneled into the equity markets and has gravitated toward technology, thus the high valuations. I get it. But you can't have stocks, technology stocks in particular, software stocks more so, SaaS stocks even more so. You can't have them trade at all-time high valuations when the economy is going through a depression. It just doesn't make sense. Companies don't have visibility into the second half of the year. And for people who are saying, oh, we're looking through 2020 to 2021. If you don't have visibility into the second half of the year, how can you be certain as to where 2021 is going? 2021 is not going to be normal in terms of growth rates for company. It's going to be a gradual process. You need to have a sense as to where the September and December quarter is going to be to understand where the March quarter is going to be. Just like what happened, not that this is going to be a similar recovery in terms of depth and duration as 2008 was, but I remember 2008 and people saying, well, you know, by the second half of 2009 we should be fine. And when that was soft, early 2010 it should be fine. It took a couple years, almost 3 years, for growth to normalize for many companies. It's going to be the same thing here. If you're going to justify all-time high valuations based on 2021 revenue and earnings estimates, those 2021 revenue and earnings estimates better be extremely robust, and you better have a high degree of certainty. I promise you, nobody has a high degree of certainty. And in most cases, estimates will not be extremely robust. Therefore, how can you justify these valuations? What if we get a vaccine? Well, what if? If we get a vaccine, it helps. If we get a vaccine, it's still not going to put almost 40 million people back to work. A lot of what ifs for the bulls. My negatives on the economy are here. Banks are tightening credit. Software companies are starting to feel some pain, particularly from the SMB. Companies weren't terribly forthcoming about that fact on the earnings calls, but you could kind of sense it on the calls. And then if you do any work outside of the earnings calls, you know it's softening up out there. Tech startups are laying off, both kind of low end that haven't received funding, Series A, all the way up to late stage. I don't know what series Airbnb's on at this juncture. And then you have public companies that are laying people off too within tech. Never mind within retail and other sectors. Where do these people go? It's going to take a while for them to land elsewhere, become productive again. That's a drag on the economy. Business travel is not going to snap back. I looked at the numbers yesterday. I think it was the 30-day average was about 93.5%, 94% down year over year. That's not going to snap back in September. That's not going to snap back in December. Tough to get big deals done if there's no airline travel. We're not going to have, companies aren't going to magically have a high degree of visibility in July on the June quarter earnings calls. They may say, hey, we think it's bottomed. And I'm telling you, you're going to see for sure a certain cohort of analysts on the June quarter earnings calls. When they hear a company say it's bottomed, they'll maintain their hockey stick estimates for the back half of the year, particularly Q4. That hockey stick's not going to materialize. What else have I heard? The mission critical nature of software. Everybody's software is mission critical till it's not. The SS&C guys, whose stock often gets pummeled when things get soft, guess what? They have about as close to mission critical software as anybody. If you're running a mutual fund, you can't not strike a NAV at the end of the day, as those of you in the business know. Lots of rules and regs. And if you look at the 08-09 downturn, guys like SS&C Technologies, Advent Software, both of which are now SS&C today, they hung in pretty well. Those businesses never really rolled over. They're pretty durable businesses. A lot of other companies who believe they have durable businesses, I would say those business models aren't so durable. So if you don't have a terribly durable business in reality, and your stock's at an all-time high, and you've got a double-digit EV to revenue multiple, there's risk there. You're not intellectually honest if you don't say there's more downside risk than upside in the near term. And frankly, over the next, let's call it intermediate term, the next year or two. So I'm as bearish as ever, and all the bulls who just want to ignore all the bearish data. They're not opinions, it's real data. I think they're frankly delusional. That's all for now. See you next time.